to talk today about the three main requirements that I look at as a lender when I'm qualifying you for a home mortgage. So number one is your credit score. Your credit score is going to determine which loan program we can look at qualifying for. I can work with credit scores in the low 500s, but there's more access available with a higher credit score. Now, keep in mind, a credit score can change. We always have the ability to look at strategies to help you improve your credit score. So it's never too early to start this step in the home financing process. The second thing I'm going to look at is your income and your debts. To determine your income, I'm going to look at a 2-year work history. Now, it's okay if you've changed jobs, but what we'll be doing is taking the average of your income over the past 2 years. If you have a gap of employment for something maybe like a maternity leave or attending school, we can usually explain that away. So don't think just because you've had job changes or maybe some gaps in employment that you won't qualify. Let's talk and look at your individual situation to see exactly where you stand. Then I'll be comparing your total income to your monthly liabilities. And this is how I'm going to calculate a debt to income ratio. When we're working with debt to income ratios, typically the highest I can go is that 50% of your gross income can go towards your debts, including your mortgage payment. Now, it's important to keep in mind, I don't consider insurance payments. We don't take a look at any payments that don't have an actual contract tied to them. Some of the things we do consider, though, include child support, alimony and separate maintenance payments, and any deductions taken directly from your payroll for things other than health insurance and benefits. The calculation of the ratio between your monthly liabilities and your income is your debt to income ratio. And this is one of the most important factors as we qualify you for your mortgage. Number one, we need to make sure we fit within federal guidelines, but then also we want to make sure that this fits within your family's monthly budget. And finally, we look at the amount of money that you have for closing costs. The amount of money that you put down impacts what we call your loan to value ratio. The loan to value ratio takes into account the total amount of debt that you owe in relation to the total value of your property. We have programs that allow you to put as little as 1% down, and there are down payment assistance programs that can have your down payment covered by an agency. When we look at your specific situation and the funds you have available, we can determine the program that's right for you. An important thing to note is your down payment does need to season in your bank account for at least 60 days. So if you're getting ready to buy a house, try to avoid large transfers in and out of your bank account and make sure that any large cash deposits have the supporting documentation that we can provide to underwriting when needed. You can also get a gift of equity or a gift of cash from a family member. So that's an important thing that we can look at right now for a lot of people that are just needing a little bit of help to get into their home. It's a conversation we can have that's a great way to invest in your children and their future to help support their first home purchase. If you'd like to take a look at your individual qualification factors and see if you're ready to buy a home, give me a call today.